Dividend stock investing riskier than you probably think it is? That's what we're going to talk about. Just a very brief but deep dive into dividends. What's the big risk with these, and why I think a lot of you are actually making a mistake by focusing on stocks just because the stock has a big dividend. We'll go through a quick rundown through today's market as well. It's pretty interesting that the NASDAQ wound up being up today after some of the news out. Let's roll the intro. This is going to be a good, quick show. Stick around. You're going to learn something really good here. All right, thanks for joining me. You're watching my live stream. I do this every Monday through Thursday. I used to say 4:30, but it's more like between 4:30 and 5. If you like what you see, please give me a thumbs up or an applause, a wow reaction, a heart, whatever it is, depending on which social media outlet you're watching on, whichever platform, because it helps spread the good word. And then you get to let your contacts know that this is pretty good content and your friends should watch it because they're going to learn something and be better off for it. And if you have any questions, you know what to do. Ask me in the comments. I'll see the question. I'll see your comment, or just say hello, words of wisdom, words of encouragement. That's always appreciated as well. But I will see it, and I love seeing it. And interacting with you is actually the best part of doing this. I see Sean out there. Thank you very much, Sean. I see Jay out there as well, and Jerry, and a few of you other regular watchers of Be the Boss of Your Money, and I appreciate it. All right, so let's just do a real quick update. All right, here, put myself up in the screen there. So the Dow is only down 74 after being down, I think at its worst, it was maybe down over 200, maybe 300 points. Believe it or not, I don't actually sit and watch the screen all day. Like, we do real work for clients, and that involves looking at something besides the market. And I actually don't think it helps anybody by looking at the stock market all day. It serves no purpose whatsoever. Short-term trading means nothing to us, as you know, but it's just good to know what happened during the day. But it was a turnaround, believe it or not. NASDAQ was up 36. I think that's like the big story of the day, considering that the U.S. government is considering putting more restrictions on high-end artificial intelligence chip sales, semiconductor sales to China, and companies like NVIDIA and Advanced Micro Devices get a lot of their business from China. We thought that maybe the NASDAQ could be down a lot more, but at its worst was down over 100 points, down only 36 to be up on the day. S&P was off a point and a half. I mean, big deal, nothing. Gold continues to wind its way lower. And that, I think, is really because inflation's been coming down. But also the Fed said today, Jerome Powell said at a conference in Portugal with other central bankers, that we've got 2 more rate hikes in the tank, maybe more, and policy will remain restrictive for some time. Oil was up a little bit, up $1.46, still under $70 a barrel. That's for the West Texas Intermediate. That's the stuff we drill in the United States, fracking, and around the waters right around the United States. And the VIX, that's just a volatility gauge. It happens to be very low at 13. But I want to show you what I was talking about. NVIDIA was off. You see this? It was down 1.8% on the day. At its worst, it was down 3.5% during the day. So the fact that it was only down 7.5% on a stock that's had a big run up over about 200% this year, not a big deal. It's up a little in aftermarket trading, and even better performing Advanced Micro Devices. It was down 0.2% today. Nothing to really shout home about. And it's up. So it was down 22 cents on the regular session. It's up 22 cents in aftermarket. So the stocks that you expected to get maybe pulverized today turned out no big deal, not a big reaction. It's tough to say exactly what's driving this. I think part of it is on Monday, there was a rush to lock in profits before the end of the quarter on these big tech stocks. Yesterday, it was a rush to chase them and show that investors, money managers, portfolio managers, mutual funds, that they have these on the books. And today, it's just kind of a flat day, and we are getting to the end of the quarter, end of the first half. coming into the July 4th holiday weekend. For most of us, this is a 4-day weekend. And I just think nobody's around. The trading is super quiet. Nobody really wants to do anything. Nobody wants to commit to anything. And people would just like to see the clock run out. And I do expect through my parking lot here in the beautiful suburbs of central Long Island, I expect by tomorrow afternoon we're going to start seeing tumbleweeds blow through because everybody is literally getting out of Dodge. They're getting out of town and they are ready for a long weekend. Friday is going to be very quiet. The market will be open Monday, July 3rd, but it's going to close early. I want to talk to you about dividends. All right. And I think a lot of you are going all about this wrong. Spotting a stock with a high dividend, there are a lot of investors that treat that like it's a good thing, like it's free money. Well, but it pays 5%. And when I hear somebody say that, I want to take the phone and I just want to, not hard, just give them a little, maybe on the shoulder, a little bad investor. No, I want to do that. Okay. Because just because a stock has a high dividend doesn't make it a bargain. That is only one metric to look at. And typically speaking, when a stock has a high dividend yield, it's because the stock went down a lot. Okay, stocks that are going up, that are up a lot, are not up because they had a high dividend yield. They're up because investors expect their earnings to be very good going into the future, where they expect some kind of invention from the company, a new drug approval, something positive. But overall, investors have a positive outlook on the future of the company. There's only one reason, and I'm telling you, there's only one reason why a stock would have a fat dividend yield. It's because the stock went down. And if it goes down a lot and the dividend is up a lot, more often than not, it means things are not going that well with the underlying company. And yet people see a fat dividend and they say, ooh, I want to buy that. And just today I was talking to a client, a very smart guy, an attorney, and he's a good friend of mine. And one of his office coworkers, another attorney, we were on speakerphone. He asked me on the speakerphone, what do you think of Walgreens here? And I'm like, well, it's got a big dividend. The stock's down a lot. I mean, to me, a stock with a big dividend that's down a lot is not something I want to buy. I think that consistently throughout my 33 years of being a financial advisor, I think that's been an awful, awful strategy. And I have yet to see anybody do well with that. I don't know what is so attractive about it. And I get it. When you get older and when you retire, you want to move out of growth investments and you want to put your investments into assets that generate income, dividends. This way, you don't have to start selling down your principal. You'd rather just take the money from dividends and interest than selling down your principal. I understand the draw. I understand the appeal of doing that. And maybe 50 or 60 years ago, you could have retired on dividends. I don't think you could do it today. First of all, we live longer. Second of all, it doesn't tell you anything fundamental about the underlying company. So the first thing to know about dividend stocks, treat dividend stocks like any other stock. Earnings, interest rates, inflation, revenue, that's all there is to it. Because just because a stock has a dividend doesn't mean it's not going to go down. People treat dividend stocks like, oh, but I have dividend stocks, I'm safe. No. So if a stock has a 4% dividend yield and the stock goes down by 50%, and you're getting that 4% dividend yield, so you're down 46% instead of 50% on a total return basis. Is that really what's going to make the difference for you? I don't think so. So that's number one. Treat a dividend stock the same as you treat any other stock. It's got to have the right fundamentals, the right metrics that you would look for. I know what I'm looking for in a stock. We could get into that. If you want to know more about what to look for in a stock, as far as I'm concerned, you're welcome to reach out to me. You've gotten my contact information. You're watching me on social media. So you can always reach me with a DM or check out clientfirststrategy.com. All my contact information is there. Financial advisors are standing by to help you. All right, so let's move on from there. And I'll give you some examples of, and these are not isolated examples. There's lots of them, but these are the glaring ones. AT&T has a dividend yield right now of nothing. Yeah. Okay. It's 1%. say they have I'm sorry, the dividend's $1. The dividend is $1. The payout, the yield is 7%. But let's backtrack here for a second. I made a video a couple of years ago about AT&T when the stock was much, much, much higher. It's like $15 a share now, and the stock was in the 40s. And I said, I don't think AT&T's dividend, which was 7% back then, because the dollar amount dividend was a lot higher. My point was that AT&T, the dividend is at risk, and I looked at the earnings, and the earnings were actually less than the dividend. Not a sustainable company in that regard. And I said they would have to cut the dividend because they can't make less money than what they're paying out in the dividend. You can't do it. You can't run a company that way. You can't survive that way. And I got some flack for it, and people would say, analysts I'm talking about, Wall Street analysts would say, no, AT&T, the dividend is sacrosanct. They would never cut it. The CEO would rather cut his right arm off than cut the dividend. Well, the guy still has his arms, and he did cut the dividend substantially. And the stock has come down a lot, and people are still looking at it with this big dividend saying, oh, this is a really good dividend yield, 7%. Dividend is $1.11. The earnings is negative. Okay, so they're not even close to covering the dividend. I don't really see how they could actually keep paying the dividend even at this level. But then, in any event, high dividend yield stock with that attracted people. And I had this one client, very annoying, used to say, hey, but it pays 6%, but it pays 5%. That was his answer to everything. Of course, he just kept buying these stocks on his own, and he was not good. Verizon, another one. The dividend on Verizon is 7%. The dividend is $2.61. The earnings are $5, but still, this dividend is still too high. Pat myself up in the corner here. Okay, you see that? Wish I'd done this for the AT&T example. The stock is down 6.5% year to date. The dividend is 7%. So why is the stock down so much? If you go, this is just a day chart, but if you look at a 5-year chart, okay, does this look like a good chart to you from the 60s down to 36? And if we take a look at AT&T, let's take a look at the AT&T. Let's go to the 5-year chart here. Look at this. Stock 5 years ago was 28. I made a video, obviously, more than 5 years ago about this. But regardless, it's now 15. Does that look like something you'd want to own? Because it has a high dividend yield. And then if we take a look at, let's say, we could look at Kraft Heinz. It's another example. But let's look at Walgreens. Walgreens was yesterday's disaster. The year high in the stock is 86. That low is suspect. I don't remember Walgreens going down to $7 a share, but 86 to 36, that is a huge loss. And even at that, the dividend yield is still almost 4%, even though the stock, and it's down almost 40% year to date. And they've come out and they said, we're going to have to lower our earnings outlook. So what good is a dividend? You lost more than half your money on the stock. Oh, but hey, you're getting a 4% dividend yield now. But keep in mind, it used to be a 2% dividend yield. The fact that it's down to 4%, to me, it does not make this stock a good buy. Now, there's a couple of ways you could get dividends in a more diversified package. That one, I'll give you two quick ways, okay? And here's what I want to do. The two most popular dividend funds, exchange traded funds, is the Divi, symbol DVY, which is offered by iShares, which we're just going to take a look at now, and the VIG, VIG, that's the Vanguard Dividend Appreciation ETF from Vanguard. They both serve a purpose, but because they're dividend ETFs, I could tell you this, they're not close to being similar. Other than the word dividend in their name of the fund, these are not the same. So let's put this one on the screen. The Divi, okay, 128, 105 is the range. It's just about 112, down a little bit today, but it is down 7%, while the S&P 500 is up about 14% year to date. You can't invest directly into an index, but you could invest into a security that tracks or mimics an index. But this is down 7% year to date. And what's the deal with this? It follows the Dow Jones Dividend Yield Index of companies that are established, typically well-known companies. You've probably heard of every company in this. Okay. So if we take a look at the profile, we look at some of the companies in this fund. Okay. Atria, that's the tobacco company. Verizon, IBM. IBM is another company that used to pay a big dividend. And I don't think investors have made money in IBM in like, like 20 years. AT&T, which we just went over, Walgreens, we just went over, and a couple of other doozies. These are companies that typically pay big dividends, but that's what they're based on. They're not necessarily based on the fundamentals of the company, and that's why it is about 21% lagging the S&P 500 year to date. And then you take a look at the VIG. It's doing better than the Divi. Or at least this one is up this year. It's up 5.5%. This is different. The yield is not as good. It's only 1.89% on the VIG, whereas the Divi, the yield on that one is 3.76%. So you could get a better yield here, but you're losing money on it. And I don't think that's really a trade-off that you want to be sticking with. It's just, I'll tell you what I mean. So this one has some different stocks. We'll look at the top holdings in this one, and you're going to see a very big difference. This one has Microsoft, Apple, Exxon, United Health, Johnson & Johnson, JP Morgan, Procter, Visa, MasterCard, Home Depot. These are seriously solid blue chip companies. These are companies that consistently raise their dividend, and that's the difference. The Divi is invested in companies that have higher dividend yields. VIG is not invested in companies that necessarily have higher yields, but it's invested in companies that raise their dividend every year, year in, year out. And that has proven to be a much more effective growth strategy than just buying companies for the sake of having higher dividend yields. So that's the difference between these two funds. So when you buy something for a dividend yield, make sure you understand there's a difference. Dividend growth companies typically do better than dividend yield companies. The reason is dividend growth companies, they wouldn't be growing their dividends if they weren't growing their fundamentals, their earnings, their revenues. And that is a recipe for higher stock prices. It's what attracts investors to them in the first place. So those are the big comparisons between those two ETFs. If you need more information, you're welcome to call me. But just remember this, not all dividend paying stocks are created equal. Not all dividend funds are created equal. And there's many kinds of strategies within the investing world that involve dividends. And the key is to find the ones that are right for you. Thanks for watching. I'm going to bail now, and I will be back tomorrow. Have a great evening.